Good morning, this is Dave Toth with an RJO MRT Technical Webcast update on the US dollar index, the euro currency, and the Eurodollar futures for Thursday, July 12th. Starting off here with an intraday 4-hourly chart of the US dollar index, you can see today's continuation of not just the past couple of weeks bull trend, but the long-term bull trend dating back to April of last year. That defines the uptrend as maintains the uptrend as the dominant technical factor currently. An important byproduct of this latest spate of strength is the definition of Tuesday's 82.98 low as the latest corrective low and tightest risk parameter. This market is now minimally required to fail below to confirm a bearish divergence in momentum to even stem this uptrend in favor of an interim correction lower, let alone threaten a broader peak and reversal threat. And certainly the 81.43 low from late June is the key long-term risk parameter this market needs to fail below to expose a larger degree reversal lower. In lieu of strength or weakness below at least 82.98 and preferably 81.43, the trend is up on virtually all scales and should not surprise by its continuance or acceleration higher. And per such, we continue to advise a full bullish policy and exposure. Moving to a slightly longer term perspective on a daily log scale close only basis, you can see the dominance of the broader bull trend, the break above late May's 83.08 high that confirms the long-term trend is up and reaffirms that late corrective low from late June on an 81.59 level on a close only basis as the level this market needs to fail below to break this broader bull trend and expose a larger degree reversal lower. In lieu of such strength, a continuation of the bull trend is fully expected. Now, it's important to point out the possibility that this latest phase of the bull trend from the late February low at 78.25 could be a completing five-wave Elliott wave sequence that could contribute to a broader peak and reversal threat. We want to keep that in mind. And for some longer-term reasons shown here on a weekly log scale close-only basis, this market is far from devoid of factors that could contribute to a major peak and reversal threat. It's important to point out that this latest phase of the broader bull trend from the 78.40 weekly low close from late February is at the level, the 83.95 area, that makes this portion of the bull trend 61.8% of the length of the preceding waves 1 through 3 from 72.93, the low weekly close back in April of 2011, to the early January high weekly close at 81.46. It's also important to point out the bullish consensus this week is at 74%. That's the highest since that accompanied the major peak and reversal in June of 2010. And it's also notable the developing potential for a bearish divergence in weekly momentum. Now, these are certainly the types of technical conditions that warn of and accompany major peak and reversal threats. The only factor that's more dominant than all these right now is the simple fact that the trend is up on virtually all scales, and hence the importance of recent corrective lows like 82.98 and 81.43 that absolutely this market is required to fail below to increase the odds of a broader peak and reversal threat. And in lieu of such in lieu of such weakness, the trend is up again on virtually all scales, and further and possibly accelerated gains are fully expected. These issues considered, a full bullish policy and exposure remain advised with weakness below at least 82.98 and preferably 81.43 required to defer or threaten that count. Moving to the euro currency on an intraday 4-hourly basis, and considering the large extent to which the euro contributes to the US dollar index, it's not surprising that the technical condition of the euro currency is virtually identical, only inversely, to that we just described for the US dollar index. You can see this week's continuation of the downtrend that defines Tuesday's 123.35 high as the latest corrective high and tightest risk parameter. This market is now minimally required to recover above in order to confirm a bullish divergence in short-term momentum needed to defer or threaten the broader slide. And in lieu of such minimum strength above 123.35, the trend is down and should not surprise by its continuance or acceleration. From a longer-term perspective, looking at the daily log scale chart, you can see the magnitude of the broader bear trend, the clear break below the late May low close at 123.65 that reaffirms the long-term trend is down and defines the 126.64 corrective high from June 29th as that next larger degree corrective high and long-term risk parameter this market is required to recover above to confirm a bullish divergence in momentum of a scale sufficient to break this longer-term bear trend. And in lieu of such larger degree strength strength, interim recovery attempts are still advised to be first approached as interim corrective selling opportunities. From a long-term perspective, looking at the weekly log-scale close-only chart, you can see the market's position to the 0.618 progression relationship of the April 2011 to Jan 2012 decline from 148.07 to 126.79. From this year's reactive high at 134.50, that 0.618 progression relationship cuts across at 122.19, combined with the lowest bullish consensus of 25% in in 11 years. This is the type of extraordinarily bearish sentiment that's typical of major base and reversal environments. But again, we would remind traders that sentiment is not, we do not consider sentiment an applicable technical tool in the absence of a confirmed bullish divergence in momentum of a scale sufficient to break this clear and present and dominant long-term downtrend. And therein lies the importance of recent corrective highs like 123.35 and certainly 126.93, the 29 June intraday corrective high, that this market is required to recover above to render sentiment an applicable technical tool and a contributor to a broader base and reversal threat. In sum, a full bearish policy and exposure remain advised with strength above at least 123.35 and preferably 126.93 required to defer or threaten this count. And in lieu of such strength, traders are urged not to be surprised by not only continued losses, but perhaps accelerated losses straight away. Finally, looking at the March 2013 Eurodollar contract, you can see the past couple of days expected continuation of the broader bull trend, with the market defining former 99.50 area resistance as new support ahead of continued gains, with recent corrective lows at 99.48 and certainly 99.45. The key short-term and longer-term risk parameters this market is now required to fail below to break this uptrend and expose a larger degree correction or reversal lower. In lieu of such weakness, further gains should not surprise. That said, however, given the relative ceiling of 0.5% that's been capping the longer-term bull trends on each of these contracts for many, many quarters now, the extent to which this market might continue to rally should be considered somewhat muted. Looking here at a weekly chart, you can see the market's approach to the 99.57 high from August of 2011. We anticipate a break above that high, but we do not anticipate much further gains. And per such, we continue to advise only a cautiously bullish policy because of the glass ceiling that exists above this market. In sum, a cautious bullish policy remains advised, with weakness below at least 99.48 and preferably 99.45 required to defer or threaten this count and warrant moving to a neutral, cautiously bearish policy. Please stay tuned to updates on these and other markets on our RJOMRT.com website, and good luck with today's trading.